You now see a diagram which is really just a reiteration of what I've been talking about here in terms of reflecting balance sheets or looking at comparative balance sheets at the beginning of the year and the end of the year, and then trying to interpret what caused the change. And hopefully then using that understanding to make decisions about whether or not the company is growing or not, and if it would be a good investment for the future. This is just a different manifestation of this diagram that I've been using to solve these prior two problems. But I want you to take a look at it, and I think you may find it helpful in really kind of pulling this all together and understanding not only these changes, but also the base purpose of the basic general purpose financial statements. You'll notice here in this diagram that on the left-hand side we have a balance sheet as of 12/31/X5. And on the far right-hand side we have the balance sheet as of 12/31/X6. So we have the balance sheet at the end of the prior year and the end of the current year, or from, another way to say that is we have the balance sheet as of the beginning of the year X6 and as of the end of the year X6. You can see that our total assets have increased. This company has grown from $4,630,000 of assets to $5,085,000 worth of assets, or a $455,000 increase in total assets. How that increase in total assets has been financed can be determined by actually comparing the beginning and ending balances of the balance sheet in terms of liabilities. And here you note that liabilities have actually decreased from $2,970,000 to $2,860,400. So not only have we gotten more assets, but we've also apparently financed, or the owners have financed, a reduction of the debt. We see that because capital stock or capital contributions have increased from $900,000 to $1 million. So apparently owners have put into the business about $100,000 to finance the growth and pay off of debt. But the most extensive source of financing or resources have been through the profits or earnings of the business. Retained earnings have increased from $760,000 to $1,224,600. This business has been extremely profitable, and that is how they have financed the growth in assets and payoff of a portion of their debts. But really, this increase, and by the way, the increase in retained earnings amounts to $464,600. Is that a reflection of the total amount of net income, or is there more to it? The fact of the matter is the change in retained earnings is as a result of earnings, but some of those earnings may have been paid out in dividends. So maybe the company was even more profitable than $464,600. We can see the level of profitability more clearly if we'll look at a statement of retained earnings. That's this bottom statement here in the middle. The purpose for putting it here in the middle is to make this basic declaration. A statement of retained earnings, which by the way, we've said before, is not required under generally accepted accounting principles. This statement of retained earnings, which is optional but is usually provided, is an explanatory statement that helps us understand why the balance sheet, at least as far as retained earnings is concerned, changed. That's the whole purpose of this statement of retained earnings, is to show what caused retained earnings to change over time. And by the way, that is why we will say that the statement of retained earnings is for a period of time, not as of a point in time. And in fact, you see that the basic elements of the statement of retained earnings show the change by identifying the balance of retained earnings at the beginning of the year. This $760,000 comes from the balance sheet at the beginning of the year, and it tries to identify then what the balance is at the end of the year, 1231x6, which is 1,224,600, and simply identifies the two things, events, that can cause retained earnings to change. The two things that cause a change in retained earnings are earnings for the year, net income, less dividends. Look at the information here. This business was extremely profitable. They had $864,600 of net income, of which they were able to pay a very generous dividend of $400,000 to the owners and still finance the growth in assets and reduction in liabilities. But net income is even better understood if we understand, as I've mentioned previously, how net income is derived. To understand the gross revenues less the expenses of the business, to really better understand this business. What is their volume of business? We can do that by looking at the income statement. Again, the income statement is here in this middle section because it helps to explain why the balance sheet increased from the beginning to the end of the year. Again, the income statement, like the statement of retained earnings, is an explanation of the cause of a change in the balance sheet. And therefore, the income statement is a reflection of activity for a period of time, not just as of a point in time. It shows revenues for the year, in this case, over $12 million, and expenses of $11,500,000. Anyway, the net income amounted to $864,600. This is a large business. Over $12 million of sales, over $1 million a month in sales, with tremendous net income or profitability as a result of those sales. Now, the one last thing that we really haven't discussed at this point in time is this one last statement appearing at the top of the middle section, which is a statement of cash flows. A statement of cash flows is required. It is one of the general purpose financial statements required under GAAP. The purpose of this statement, and the reason why it's appearing here in the middle, is again, it is an explanatory statement that seeks to show what causes a change from the beginning balance sheet to the ending balance sheet, but it exclusively focuses on cash. It seeks to explain why cash has increased from a beginning balance of $80,000 to an ending balance of $110,000. In fact, some people would say, hey, you had so much net income or profitability, cash must have increased significantly. But you can see here that cash really only increased by $30,000. The statement of cash flows focuses on cash because cash is such an important and valuable asset in just making sure that the businesses can operate. And in this particular case, the statement of cash flows seeks to identify what caused a change in cash from the beginning to the end. Well, we can tell that the change in cash was a $30,000 increase. It increased from $80,000 at the beginning of the year and has a $110,000 balance at the end of the year. The change must have been $30,000. So the essence of the statement of cash flow seeks to identify the major sources or uses of cash, creating a net cash flow increase of $30,000. Under generally accepted accounting principles, it is required that the basic form of a statement of cash flow show three basic categories or classifications of cash sources or uses. One of those classifications is net cash flow from operations. This means, cash inflows from the sale of our goods, less cash outflows as a result of the costs or expenses of providing goods and services to customers. In this particular case, you can see that the cash flow was $973,500. This is not equal to net income because some of our expenses and our revenues or sales may not be for cash. Sometimes we make sales to customers and receive accounts receivable or promises to receive cash that we will not collect until the next period. So in many cases, there is a difference between the amount of actual net income reflected in revenues and expenses because of how we define revenues and expenses, and the cash flows from operations. In this particular case, the cash flows are a little bit higher than our actual profitability from operations. You can see that we did generate a significant amount of cash, but a large chunk of that cash, in fact, all of that cash was really used to pay out costs of investment, net cash outflows from investing opportunity or activities. Investing activities are in most cases the purchases of investments. So for example, long-term assets like more buildings and more equipment and maybe even investing in the securities or of other businesses. If in fact we take cash, we may be utilizing it not necessarily just to provide for expenses of current operations, but maybe investing in resources that help us in future operations, and apparently that has happened here. We've used over $1,188,000, of cash to build the resources of the business. So we must have gotten some capitalization beyond just operations in order to actually be able to create this additional resources of our business. And these apparently came from financing activities, either the borrowing of funds from creditors or from owners' contributions. And apparently, the net cash flow in this particular business from financing activities was an increase of $245,400, giving us a net cash flow of $30,000 and increasing our cash balance of $110,000. Again, the final point to be made here on this diagram is that the statement of cash flows and the statement of income or operations, these two required financial statements are financial statements that hopefully provide some explanation of what causes a change in the balance sheet from the beginning to the end of the year, and gives us some explanation that helps us do a better analysis of really what's happened to the business over the last year, and can we use that information to make projections in the future.